everyone. My name is Alina Vazanen, and I work at the Canadian Women's Foundation on the Community Initiatives team. So thank you for joining us today for our capacity building webinar called Demystifying: Financial Analysis, Modeling, and Investment Readiness. So before we get started, I'd like to acknowledge that the work at the Canadian Women's Foundation and the organizations that we support takes place on traditional First Nations, Métis, and Inuit territories. We are grateful for the opportunity to meet and to work on this land. However, we acknowledge that land acknowledgements are not enough. In all that we do, we should make sure we pursue truth, reconciliation, decolonization, and allyship in an ongoing effort to make right with our relations. If you haven't already, please make sure you select a language. We have interpreters here today working to make sure that everything Ashley and I say is translated into French if necessary. So at the bottom of your screen, please select English or French. If you have any questions, please type them in the chat box. As with all online meetings, if we have tech issues, we will do our best to resolve them from the back end as quickly as possible. And finally, at the end of the webinar, we're going to be sending out an evaluation survey. If you can, please take the time to give us your feedback. Now, I would like to introduce our speaker for the day, Ashley Wang. So I'm very excited Ashley's with us today. She's an associate at Social Venture Connection, where she works with social purpose organizations and impact investors. She leads the firm's due diligence and investor relations desks, reviewing impact investment opportunities across sectors and asset classes, and supporting investors in mobilizing their capital towards purpose and profit. In her position, she's also a member of the Women of Ontario Social Enterprise Network, where she designs and delivers programming for underrepresented women and non-binary entrepreneurs. It's a privilege to have her here today. We're very excited for your presentation, Ashley. So thank you so much. And now I am going to stop sharing my screen and allow you to proceed with the presentation. Thanks so much.
Perfect. Thanks so much, Alina. I am just going to do a quick migration of the screen share, so hopefully everyone can see the slides that I'm working with. Maybe get a thumbs up from Alina to show that we're all good just on the slides. Okay, perfect. Thank you so much to everyone for joining today. Really thrilled to be able to share some information with all of you around the topics of financial analysis, modeling, and investment readiness. I know those terms can be a little bit scary sometimes if you're just getting your feet wet along your investment readiness journey or are considering, what that might even look like for your organization. So hopefully I'll be able to provide some clarity on what those things mean for you today. We only have about an hour together, so just a quick disclaimer that we won't be able to touch on everything. You won't come out of this webinar completely investment ready. It will take and be a long journey and will take time. But hopefully, again, this is just a way for you to start exploring what this will look like for your organization if that is something that you're interested in. And then you will, I'm sure, get the slides afterwards to refer to any terms or the slides in general if you have additional questions following the presentation. So I will just dive right in. And Alina's already, done the land acknowledgement, but I just want to take time to just ensure I share where I am sitting and acknowledge the land from where I am in Toronto, which is covered by the Dish with One Spoon Treaty and the Toronto Treaty of 1805. And where I reside in North York is also part of the Williams Treaty of 1923. So I think just really important to acknowledge that before I start today's presentation, and just give thanks to the stewards of the land, both in the past, present, and future, before we dive in. So great. So as I kick off the presentation, I think probably important to do some overview of SVX, Social Venture Connection. So we're a nonprofit financial services firm, and we design strategies, manage products, and mobilize capital for a variety of organizations and investors, ranging from nonprofits and social enterprises to impact funds and investors. And we also support folks across asset classes and sectors. So clean tech, food, social inclusion, health, those are all examples of sectors that we will support in terms of impact. A little bit more about us. We operate a digital platform. So if you log on to svx.ca, you'll essentially see our platform where social purpose organizations who are raising capital can list their impact investment opportunities. So quite an exciting platform if that is something that you'd like to explore perhaps for your organization. We also provide advisory services that develop investment readiness and capacity build amongst these organizations that are looking to raise capital. Operating as well from a fund design and management approach. So SVX designs as well as manages impact investing funds across Canada. And then finally, really quickly, just chatting about investor and venture education. So, conducting presentations like this to build capacity amongst social purpose organizations and investors so that we one day live in a world where all investments are impact investments and all enterprises also have a social, environmental, or community mission. Over the past since 2007 or so, we've built up a network of over 900 investors supported in mobilizing over 150 million in capital, and have also scaled our operations across a couple countries. So at least to say that investment readiness is exactly where we operate, and that's what we're hoping to help demystify for all of you today. Alina has provided an introduction of myself, but I, as she mentioned, lead our issuer due diligence and investment analysis, as well as our investor relations. So conducting the actual analysis on social purpose organizations who are raising capital. So really trying to get an understanding of whether or not it's going to be a sound investment opportunity for our investors, and then chatting with investors to try and place that capital. So hopefully we'll be able to provide a helpful perspective today on what investors will be looking for if you choose to embark on this journey. So just going over our agenda for today quickly, we'll start with an introduction to accounting and financial analysis, then chat a bit about financial modeling, and then really quickly at the end, we'll also dive into investment readiness. And you might be asking, why are we covering sort of this accounting, financial analysis, financial modeling piece when where we want to be is investment ready? And during our sort of initial surveying process, when we came up with the series for the Canadian Women's Foundation, we discovered that in order to talk about investment readiness, we really had to do a lot of education, starting from square one, because a lot of folks are at various stages amongst said investment readiness continuum. And so it's really important to provide a primer for those essential skills that social purpose organizations require, like accounting, financial analysis, and modeling before we even dive into investment readiness. So that's what we'll provide a bit of a flavor for in each section today. So I will just dive right into the introduction to accounting. So what is the big deal with accounting? And what does the word accounting even really mean? So likely many of you have accountants that you work with within your organizations, but again, really important for you to understand your own financial statements and how the accounting process works for your organization. And so accounting is recording and tracking and reporting on financial transactions that occur within your business. And the financial statements, the three key ones that you'll want to know about and that we'll talk about in today's session, are your income statement, your balance sheet, as well as your cash flow statement. So a couple different names for those particular statements that I've also listed here below. But why should I care? Again, really important to understand accounting because this is the way that you will understand your social enterprise's operations over time. As well, having an understanding of your accounting and situation, as well as your financial statements, really demonstrates financial acumen to key stakeholders and partners, as well as potential investors who might be interested in investing in your organization. It also allows you to report back to your key stakeholders, and of course allows you to make effective decisions. When you understand the financial operations of your organization, this really allows you to make those sound decisions because you understand what is happening internally. And so I will dive quickly into all of the various financial statements and just provide a primer on each of these 3 statements that are important for you to know. But we'll also use a case study later to make things a little bit more tangible as well. So first, on the income statement, sometimes called a statement of operations or profit and loss statement. This income statement reflects your operations over a period of time and will list your revenue, so what you've sold and how you are making money, what it costs you to actually make those revenues, so your expenses, as well as the thing that investors care about the most, profit, how much you are making from operating that business. So those are the 3 key components of your income statement. Diving into the balance sheet, your balance sheet, instead of representing a period in time, represents a single point in time. And so you've probably seen some of these words before, again, looking at your financial statements if you work with an accountant or if you've prepared one in the past. But you have a section for your assets, so what you own from within your organization, your liabilities, what you owe to others, and then your equity or your net assets. So we'll go into that just a little bit. So assets are things like cash, accounts receivable, as well as any property that you might own from within your organization. Your liabilities show, again, what you owe to others, so both on a short-term and a long-term basis. So any credit card payments that you might have to make, any line of credit that your organization has, as well as if you own a building, again, you probably have some sort of mortgage on that. So that would be classified as your liabilities, what you owe to others. And then the last section you should be familiar with on the balance sheet is your equity. If you're a not-for-profit organization, this would probably be called your net assets. If you're a for-profit organization, this would be listed as your equity. So you can think of your equity as the amount that is available for the organization to use in the future. So a bit of an interesting concept, perhaps, if you're not familiar with this. But essentially, as you make money over time, your net income from year over year will accumulate in this bucket called net assets or equity. As well, if you have any funds that are contributed by donors, this will all kind of gather in that equity bucket, and you can use it to fund your operations in the future. I know I'm jetting through all of this, but I have one last statement to share with all of you, and it's the cash flow statement. And contrary to the statement of operations or your income statement, this statement in particular focuses on your cash flow. And you've likely heard the term, cash is king or cash is queen. And this particular statement is important because cash is the lifeblood of any business. If you do not have cash on hand, you won't be able to do things like pay your employees, or you won't be able to pay your credit card or your mortgage payment. So really important for you to have cash on hand. And so this cash flow statement identifies at what point cash is coming into your business and what point cash is leaving the business. So really important, and probably one of the most important documents that investors will want to see as well. So we're going to dive into financial analysis. And I think this section is the one that will make the accounting portion a little bit more clear. And again, we'll walk through a case study for how accounting and financial analysis can be used, and how an investor might look at an organization's financial statements and conduct their own financial analysis to determine whether or not some social purpose organization is one that they might be interested in investing in. And so what are investors looking for? They will conduct financial analysis and will ask for your financial statements to determine whether or not your business model makes sense, whether you're able to generate a return on investment over time, and really just to understand, how the business works. And so by looking at your financial statements and conducting that financial analysis, they'll be able to answer some key questions that they have about your organization. So things like, are you making money? If not now, then when will you be making money? Revenue and sales, are people willing to pay for your products and or services? What is the margin that you have on your revenue? So what does it actually cost you to make a sale? As well as a couple other things, how quickly are you growing? Questions about scalability. So does growing the company allow you to decrease your costs over time, allowing you to capture more, margin? How much debt do you have on your books? How much cash do you have? And some other key questions as well. So these are all examples of questions that can be answered for investors just by looking at your financial statements. And so that's why it's really important for you to have an understanding of what your financial statements are saying to investors, because they will be able to tell, your financial fitness and how good of an investment opportunity you might be as an organization based on your financial statements. So let's look to make this a little bit more tangible with a case study. So we'll chat about an organization called Urban Farm. So this is a fictitious organization based on a real client that we've worked with in the past. So again, all fictitious information, but Urban Farm was an organization founded by fictitious Teresa Singh in Ottawa. And the problem that Teresa was trying to attack was that she discovered a food desert in a low-income, marginalized community in Ottawa, where access to fresh produce was extremely limited, and the nearest grocery store was over a 40-minute walk away. And so she noticed that the problem in her community was that they were spending more money on food delivery, fast food, and snack food, just based on convenience. And so she decided to do something about it, which many of you on this call, I'm sure, have done as well. So she found a sizable plot of land that backs onto the highway with hydro lines close by that could, irrigate the farm. And she was looking to actually purchase the plot of land. And so prior to this, Teresa and her 3 friends, decided to start a nonprofit community farm and make it operational. And at this point, they have the sizable plot of land that they are looking to investors for potential investment so that they can purchase the land and expand the operations of their nonprofit community farm. So at this point, just to provide a bit of context, this organization was already operational and they had some sort of donated or in-kind land that they were using to run their operations. But they were really looking to scale up at this particular point in time. So we're going to run through what financial analysis would look like for this organization from that investor's perspective. So essentially, I will play the role of the investor and start to ask a couple of questions about the organization based on what we see from their financial statements. So this is hopefully, again, a tangible way for you to put yourself in the shoes of an investor as well. And to do that financial analysis with your own organization, because taking that perspective is really helpful in understanding, again, what your financial statements are communicating to investors and to your key stakeholders. So let's just dive right in. I know this slide has a lot going on, but as you can see, this is their income statement. So Urban Farm, at the end of 2018, this is what had happened within their business. So you can see the revenue on the left, as well as their cost of goods sold and their gross profit. So the revenue, and then below it, sort of what types of costs they had to incur to generate this profit. On the right, they have their expenses, so more general costs associated with operating the business, like advertising, administrative costs, insurance, tools, for example. So this is the way that they had actually, you know, when they came to us as an organization and were looking for support, this is what they had come to us with. And so we had a couple questions and a couple comments on the income statement that they had. So I will just point out a couple key observations that we drew, and hopefully that sparks some thinking for you in terms of, you know, what does your income statement look like at the moment, and sort of what kind of conclusions can you draw. So the first thing I'll just say is that for an organization that has only, you know, been in operations for about 2 years, I think great that they are able to generate revenue and that they are generating net income. However, they do have quite a messy income statement here. So as you can see, the 4 sort of boxes that I've placed around here kind of outline the same thing. So freight and delivery, fuel, food, shipping and delivery expenses, a bit confusing as to, you know, why this particular expense appears in so many different places. And because the business model is essentially, you know, they're selling their produce to a variety of customers, we're hoping to see a bit of a cleaner income statement. And so hopefully that's something that between yourself and if you have an accountant, you would be able to simplify to make it just easier to tell the story of your business and how you are making money and what your costs are. The other thing that I'll just point out as well that caught our attention was this increase in fundraising revenue. So you can see in 2017, they had about $8,000 in fundraising revenue. And then in 2018, they were able to bump that up significantly and get about $20,000 of fundraising revenue, which is a really great sign. And so, you know, their gross profit is increasing and their margins are increasing over time because of this fundraising revenue. So again, a really great sign. Sorry, I'm just going to go right back. However, the one comment that I will make is, you know, always great for you to be receiving fundraising revenue, but I, as an investor, want to know if this jump in fundraising revenue or revenue in general, if that is going to be sustainable over time. So, you know, are you going to continue getting this level of support to grow and scale your business? Or is this sort of a one-time thing? You know, as an investor, I'm really looking for an increase in revenues and an increase in profitability that is a result of the business itself, not necessarily grant writing. And, you know, this is a bit of a tricky piece because grants are so fundamental to getting your organization off the ground. But for an investor, they want to see that that growth is sustainable. And we all know how time intensive it is to write grant proposals and how, you know, difficult it can be sometimes to get those dollars into the organization. So really important that you're driving towards financial sustainability over time and not just relying on fundraising revenue if investment readiness is potentially a path for you. All right, so I'm going to go into the balance sheet and do the same sort of analysis with you all. So just identifying a couple key components that jump out for me as we conduct this analysis from the perspective of an investor. So you can see here again that the total assets for the organization have gone up significantly from about 7,000 to 30,000, which is great. However, again, you can see that this is all primarily tied to that increase in fundraising revenue. So just, you know, wanting to be conscious that the organization in terms of its assets, not necessarily growing because you're obtaining a significant amount of assets, but because a lot of that is coming in through cash through that fundraising revenue that you were able to get. Some other comments. So you can see here that, you know, they have about $7,000 in fixed assets at the end of 2018. So that covers things like equipment, fencing, hand tools, and supplies. And so actually, you know, despite the fact that they don't have land on their books right now, they're actually quite an asset light business. And so it actually doesn't take them, you know, that much money to be able to acquire the tools that they need to grow their business. And so this is good in terms of scalability. meaning that, in order to potentially make more revenue and drive more business to the organization, you won't actually need to invest that much in terms of upfront resources, which is also a pretty good sign. And the last thing that I'll just say is that with these two accounts, so accounts receivable and inventory, you can kind of think of accounts receivable as if you were to have a credit line for your customers for your business, a deal that allowed them to pay, 60 days later than they actually receive the services, for example. If you had anything like that, then that's what would appear in your accounts receivable. However, this organization, again, doesn't have a ton in this particular account, meaning that a lot of your customers are actually paying likely in cash, which is, again, a great thing for your business because, again, cash is the lifeblood of your business. And so the faster you can convert your sales and your revenue into cash, the more efficient your business will be. So cash in can immediately become cash out, allowing you to pay off your credit card or any sort of line of credit that you might have for your organization. So we're going to do this now for the last statement that we were chatting about, so the statement of cash flows. So as you can see here, we're starting with cash, the beginning of 2019 at about $1,400 worth of cash, and we're ending the period with about $22,000 in cash. And so the biggest contributor to this is your net cash from operating activities. So that is really driving the increase in cash that you have as an organization. And a lot of that, again, is coming from your net income, which is great news as an organization. This is exactly where you want to be generating cash in your operating activities, meaning as you operate your business, you are generating cash from actually, running the business. So that's a great sign. There are some investing activities happening here, meaning that as an organization, you are investing in some things like equipment, fencing, hand tools. So you have some negative cash, meaning you're paying out about $3,300 this year just to invest in some new resources, which completely makes sense. And you also have a little bit of money coming in from donated capital, which is great. However, again, I think what I'd like to draw your attention to is just that this net income figure can be a little bit misleading. And that's just because, again, a lot of this cash from your net income is coming in from that fundraising revenue. So being a little bit of a detective here, when I'm looking at, it's great that you have cash on hand, but now, how are you going to generate that cash going forward if you don't necessarily have that consistent fundraising revenue? That's what I want to know as an investor. So how do we answer some of the remaining questions that we have for this business? So, as an investor, perhaps I'm deciding whether or not I want to contribute some money to Urban Farm so that they can purchase the mortgage, so that they can purchase the land and take out a mortgage and actually expand their nonprofit community farm. I have some remaining questions. So those would be, how are they going to use this $22,000 in cash that they have on their books going forward? And should I expect that they're going to receive these fundraising dollars each year? How are they actually going to generate cash if they don't have that $20,000 again? So that's a point that I've driven home a couple of times, but again, super important. And then the last one that I'm really curious about is, how will this cash infusion help to make the Urban Farm's revenue and business model more sustainable in the long term? So will this $20,000 allow them to unlock some sort of model in their business that allows them to be super profitable in the future? That's what I'm really curious about. So how do we answer some of these questions? That is where a nifty thing called financial modeling comes in. So we're going to cover financial modeling at a pretty high level again. So continuing on with the case study of Urban Farm, we're going to model what their future might look like in terms of their financial situation, given that they actually are able to purchase this land. What will their business operations look like? And so I think financial modeling is like one of those terms that is perhaps a bit scary as well, but hopefully we can do a little bit to demystify what exactly that means. So we'll start off by just chatting about what is a financial model. And so a financial model is a whole bunch of things, but it starts off as being a tool to forecast your business's financial performance into the future. So if we are sitting in 2021, this is a model, a way for you to forecast what your financial situation will look like in 2022, 2023, 2024, and so on and so forth. It's usually something that is built on Excel and not hard-coded. We'll chat about what hard-coded means in a couple of slides. And it's also a way for you to test what might happen if certain events occur, for example. So if I'm expecting, next year that I'm going to be able to double my sales, what happens if something like COVID-19 hits and we're not able to double our sales in the same way that we originally predicted? Your financial model is a way for you to test those various scenarios that could occur. And so bottom line, a financial model is your best guess for how much money your social enterprise will make or need in the next 3 or so years. Why are financial models important to investors? For an investor, it's really helpful to look at your financial model to understand what your plans are for the future. So with the case of Urban Farm, for me as an investor, it would be understanding, what are you going to do with the $22,000, or, how is the business going to be impacted if you take on this mortgage that you have and that you'll be planning on doing in the coming years. It's understanding what my money as an investor will do for your business. So again, what goals and milestones will my money, say if I give you $50,000, what will that $50,000 allow you to accomplish? And also a way for you to understand whether or not the team that you're potentially giving this money to, how good they are at achieving their stated goals. So if I were an investor and I were to look at your financial model and you projected that you would, double your sales in 1 year's time, if I come back 1 year from now, would you have accomplished that doubling in sales? And does that sound like a sound sort of goal for the organization to have? It kind of tests the savviness of the entrepreneur to understand what their situation is and sort of what their goals are and how they will achieve them. So this probably looks familiar as we just went through it a couple minutes ago. But again, wanting to make the financial model super tangible, your financial model is essentially a set of statements that are forward-looking, while your financial statements are your backward-looking representation of your organization. So again, this particular statement of cash flows, for example, was for the year 2018. And so I could, if I were sitting in 2018 and I wanted to project what my 2019 and 2020 looked like, that would be a financial model and it would look exactly like this. But if this were for the years 2016, 2017, and 2018, then they would essentially be financial statements because they are backwards looking. And so depending on what essentially moment of time you are sitting in and when you are projecting and reflecting on what has already happened, that is either your financial model or your financial statements. So hopefully that provides a little bit of clarity in terms of what the heck a financial model even is. And so when you build a financial model, a lot of this just comes down to assumptions. And so this is your essentially best guess of how much you will generate in sales next year, in 2 years, 3 years, how much you think it will cost to run the business, what your main expenses will be, so rent, marketing, wages, And it all comes down to your knowledge as an entrepreneur for what the market will look like. So market trends, as well as your historical data. So what information you have been provided to date that would make you think that you'd be able to make that amount in sales, or that your cost would be that amount. So again, I'll hopefully make things a bit more tangible in the next slide. So this is the revenue projections and the financial model, or at least a portion of it, for Urban Farm. So this is what they came to us with as well. So you can see here that they are projecting that in 2019, that they would have made about $27,000, that in 2020, they were going to make $50,000, and then in 2021, they were going to make $66,000. So those were their estimations for what their sales were going to look like. Keep in mind that we are sitting in this particular situation back a couple years ago in 2018. So what they've done here is estimated, how many restaurants are they going to be able to sell their fresh produce to in the community? How many households and families are going to come and purchase from them? So they've made estimations around the number of customers that they'll be able to get, based on, again, a mix of their market research for what restaurants typically purchase, as well as some of their historical data. And as well, what they've done is estimated how much each of these types of customers are going to spend. So they've estimated that, in 2019, they would spend about $22.50 each month or annually from each of these wholesale restaurants, and then that this would grow over time as the restaurants perhaps wanted to source more of their produce from this community farm. They've also predicted that over time, the amount of households that would want to purchase from them would grow over time, and also would spend around the same amount, so $165 annually per year on their produce. So that is how they're arriving at these annual projections. And so the pro forma income statement is just a fancy way of saying this is their financial model for their income statement. So that's how Urban Farm has put that together. What they've also done for their financial model is estimated what their costs were going to look like. So they've likely done this from looking back at their financial statements, and then, going through and projecting how much things are going to cost in the future. And so here, as you can see, the costs associated with their staff wages, for example, they're estimating here in 2020, I can clearly identify that this number is going up a significant amount, meaning that they're likely hoping to take on some sort of full-time or additional part-time staff in order to grow the business, which makes a ton of sense as they're looking to expand their business. Another great tip that I will just share with all of you as you are all building out your financial models, but perhaps in the future, is that they've also included a replacement budget and a contingency budget. So they've set aside a certain percentage of their revenue, specifically just going towards, this contingency fund of additional funds in case something happens. So that's a great idea for you to incorporate into your financial models if you haven't done so already. And something super important is that they've modeled in what this mortgage payment is going to look like into their financial model. And so in 2018, they don't actually own the property yet. And so of course they don't have that incorporated into their operating costs, but they want to understand what their financials are going to look like if they take on this mortgage payment. And so they've incorporated that directly into their operating costs, which is exactly what you will want to be doing, because you'll essentially want to model exactly what you predict will happen in the organization, so that you can see, what your profits will look like at the end of the day with all of your costs and all of your potential revenues considered. So here what they've done is now put both parts of that financial model together. So here outlining it again, they've put their revenue up at the top. So these are their estimations around how much money they are going to make in 2019, 2020, and 2021. They've subtracted a whole bunch of their costs here. So cost of goods sold, what it's going to cost them to actually make that revenue. And then they've also predicted some additional figures around, how much in grants they'll receive over time, how many donations they'll get, some corporate sponsorships as well that they're expecting will come into the business again in 2019 through to 2021. And then, of course, this key component of including their operating costs. So what they're doing here is taking all of their revenue, subtracting their operating costs, and then getting to this final number of net margin. So this net margin is essentially telling you, in 2019, if we take on this mortgage payment and things go exactly as we planned it, are we going to make money at the end of 2019? And the answer is, if things go exactly again as planned, unfortunately, no, in 2019, you will actually not be netting out positive. And so you'll actually be incurring a loss in that first year. And so perhaps for some of you that's raising some flags, but actually for many organizations, it's quite common that you might incur a loss in your first year. However, as you can see, they're growing that net margin over time. And so taking on that mortgage perhaps is just a way for them to unlock additional profitability in the future. So I know I've gone through a lot of content today so far, but I just want to chat really quickly about this concept of, but wait, what happens if things don't go exactly as I planned it? So I put things into my financial model and I make all these estimations around how many customers I'm going to get, how much they're going to spend. I find all this information about like how much my expenses are going to be and how much my mortgage could be. But what happens if my mortgage ends up being more than I anticipated? Or what happens if I make more or less sales than I expected? And so that's where this nifty thing called scenario planning comes in. And so that's just again, a fancy way of saying you can actually manipulate your financial model to adjust for different scenarios that could occur in your business. So again, some of the ones that I mentioned are if you don't meet your sales targets, or if you are doing great and you surpass them, if you incur more or fewer operating expenses, if you don't even decide to take on that mortgage, what will your financial situation look like? And so scenario planning as a concept is essentially, you taking your financial model on Excel and adjusting some of the numbers so that you are able to predict what will happen in the worst case, the best case, and the most realistic case. So maybe if I just even flip back a couple of slides, hopefully this still makes sense and that you're following. But if I go back to the revenue projections, scenario planning, again, while it sounds like a fancy term, is really just you kind of adjusting some of these initial assumptions that you're making. So instead of 12 restaurants, maybe you want to put 20 restaurants in your first year, and then 50 in 2020, and then 100 in 2021. Scenario planning is just a way for you to play around with what those various scenarios could look like. And because you've built out this model on Excel, you'll actually be able to adjust what this bottom line would look like. And so if I were to build this out on Excel, this number would also change to indicate how much money I'm making or losing depending on the various scenarios that have occurred in the organization. So hopefully that makes sense, and then I'm not jumping through slides too much. But that's why hard coding versus soft coding, again, so important. And so I won't dive really too far into soft coding or hard coding today, but this is absolutely something that you can take the liberties of perhaps looking up a video on YouTube. But when you hard code, for example, you are putting in these exact numbers into your spreadsheet on Excel. So, typing in 1 plus 0.06, And unfortunately, that's very inflexible. And so if you were instead to soft code and do 1 plus this particular cell, for example, then you would actually be able to go in and directly change, if I wanted to make 0.6, 1% instead, or 10%, it would essentially allow or push Excel to automatically update and recalculate what this formula would look like if you were to enter some different values. So a concept and a quick tip perhaps that is just helpful for you as you perhaps develop your financial models. I will hopefully take a couple minutes at the end just to answer some questions, but I promise almost through the entire hour actually already. But as promised, I want to take some time to just chat about investment readiness, this elusive investment readiness phase or term perhaps. And so maybe just starting with a quick statement that the investment process, depending on your organization, will look very different. And each investment process will follow a different path. But generally, the steps can the steps below can kind of give you a sense of what that might look like for your organization. So this first stage of preparation is going to be super important. So understanding, how much capital do you need? What security makes sense? So, do you what kind of capital do you want to raise for your organization? And then through to actually being able to talk to investors with investor strategy, doing the pitch, and then negotiating what those terms look like, and then finally making the investment. So this kind of will be the process that you would follow as you move through the investment process. And so as you gear up for investment readiness, a lot of the initial work will be in this preparation phase, because you will be, putting your business plan together, you will be putting your financial model together, you will be making sure that the social enterprise or that the organization actually works and that you're able to be profitable and generate revenue and profits for potential investors. And so you'll probably spend the bulk of your time here. And then, as you get closer and closer to investment readiness, you'll move through the various stages of the process, from investor strategy all the way through to investment. And so maybe just some key questions that I'll answer, because I think these are the questions that we get a lot at SVX. And then afterwards, we'll transition into a Q&A. I know I've been talking for a while, so hopefully we'll be able to answer some questions from all of you. So when are you ready to raise capital? So often what we hear a lot is, I want to raise capital because I have an idea, or I want to build my product, or sometimes, unfortunately, it's I'm running out of cash and I need to pay my team next month. Unfortunately, these are not, from our perspective, reasons to raise capital. Instead, when you want to be raising capital is when there is already some sort of proven track record for the impact of your organization or for the financial sustainability of your organization. What investors are really looking for is that you have some existing traction and proof that the business works. And so another good reason is that you want to scale your business, and you're at the point where you want to perhaps expand across regions, across the nation, worldwide. Or another great reason is, in order to achieve some roadmap and the certain milestones that I want to achieve in my business, I will need capital in 6 to 9 months from now. That's a much better time to raise capital than when you need the cash tomorrow. You want to give yourself some runway to actually raise that capital. Another common question that we get is, how much capital do we need to raise? And so that's where your financial model becomes really, really important. And so your cash flow can be estimated using your financial model. And so I'll just walk through at a very high level again, sort of what that process will look like. But essentially, you as an organization, you'll want to outline what your major milestones will look like over the next 18 to 24 months or so. What do you want to accomplish within your organization? You'll map out what your expenses will look like in order to achieve those milestones. So, do you have to pay a whole bunch of new people to come onto your team to achieve that national expansion? Will you have to find some new space to accommodate for those new staff members? Will you have to pay, accounting or legal to be able to perhaps, get your intellectual property patents in place? Those are all considerations for what your expenses could be. After that, you will map out what your expected revenue is going to be. So if you achieve all of these milestones, how much money do you think you're going to make? That's a really important key component to consider as well. And using your educated assumptions, again, from your financial model is super important at this stage. After that, PowerPoint is going to do some fancy things now. And essentially, your expenses minus your revenue is the amount of capital that you will need to raise. So this entire blue area, summing all of that up, that is how much money you will need to raise for your organization. It's really how much money are you currently at a shortfall for that you would need to essentially source from additional sources, loans or investors, to be able to fund and achieve those milestones. So I think what I'm actually going to do is perhaps pause there. There are a couple other slides around, what type of capital should I raise? But I think perhaps even more useful for all of you to just take a look at those slides, following the presentation, and perhaps we'll just do some questions for the last 5 minutes or so, because I know we are winding down for time. So maybe I will just skip it through a couple of slides through to the Q&A.
Thank you so much, Ashley. We had one question come up while you were presenting, and it's a question about templates, actually, and whether you have any available, and maybe there's more resources from SVX too. Is that an opportunity?
Sure, great question, Nicole. So on the financial analysis piece, I would say that not necessarily a template that is often provided or really exists. There are some sort of key questions, again, that were in that slide a couple slides back around profit, margin, burn rate, that kind of thing, that are often the metrics that an investor might look at to do the financial analysis. But I would say there's not really sort of like a template that follows that process. For reporting or financial modeling, which is, I think, perhaps what you might be getting at with this question, we actually do have the, I guess, modified version of the Urban Farm financial model that we can absolutely share with all of you, so that you can just go in and flip through the tabs to see, what this organization did, how they modeled for the future, what their key assumptions are. And then also what you can do is play around with those assumptions. So again, if you see that Urban Farm originally predicted that there were going to be 20 different restaurants that they were able to sell at, what you can do is put in, slash that in half and say 10. Like, what if they only were able to get 10 restaurants to come on board with their organization? You'll be able to see that immediately sort of calculated through their financial model, and you'll be able to see how that impacts their profitability. So I think probably a cool exercise for all of you to just go and do, perhaps after this webinar.
Thank you. Getting some nice comments coming through. I had a question for you, Ashley, about your work with the Women of Ontario Social Enterprise Network and your work with women and non-binary entrepreneurs. Do you think in these processes, there's anything that's different for some of all gender-based women's startups or organizations like that? Have you come across any differences like that?
I will speak to this at perhaps a high level as well, but absolutely is essentially my answer. And there are definitely barriers that I think myself, I have seen organizations experience when coming into this world of investment readiness. It is absolutely a field that is dominated by cisgendered white men. And the reality is that most funding, venture capital funding, only like 2% of it goes to women-led organizations, which is absolutely ridiculous. But there is absolutely a systemic barrier that exists that often, prevents women-led organizations or organizations that support women. It prevents them from entering the space even in the first place. And so there's a lot of anxiety that often exists, even with this relationship to money that I think can be quite daunting for women entrepreneurs and, again, folks who support women. And so, some of those key pieces are immediately, like, capital just typically does not flow to those types of organizations because of systemic reasons. If you have a product that supports women and girls, because the investment space is so dominated by men often, a lot of these investors don't even understand the products sometimes that you're selling and sort of the value that your organization brings. And so some of those opportunities are kind of written off, even though they really shouldn't be. And so absolutely like a recognition that barrier exists. But hopefully, I think the work that the Women of Ontario Social Enterprise Network and as well the Canadian Women's Foundation, hopefully the work that all of us are doing is starting to break down some of those barriers and to provide more opportunities, because that is absolutely the reality. But hopefully it doesn't need to be going forward, but the change will be slow. And so what I would say maybe is just to be patient with yourself if you are embarking on this process, and that to understand that this world is often not, made for us. But that's not a reason that you shouldn't participate. It is the system that has to change.
Exactly.
So that is my honest answer.
No, thank you. I feel like we could listen to you talk about that for even longer, a whole other webinar, but we really appreciate the practical skills that you've given throughout today. We're almost running out of time. Actually, I think we are out of time. So I wanted to say thank you so much, Ashley, for coming today and speaking to us and helping us learn hopefully something new and you hadn't thought of before. And so I also want to say thank you to the Investment Readiness Program that presented this webinar today. I'm just realizing. I just want to say thank you to IRP, Investment Readiness. I also just want to say thank you so much to our interpreter today, Miriam, for translating our words. Thank you, Miriam. And then just let everybody know that the slides and the presentation will be available later through the Canadian Women's Foundation, and it will be on our YouTube channel. So if you have questions, it looks like Ashley's put her email address up there, which is amazing. And that's everything. Thanks so much, everyone.
Thank you. Just hopping in to Mia. I know I didn't answer your question, but if you want to send me an email, hopefully I can help you there.
Yeah, I wish we had more time. Thank you so much, everyone.
Thank you. Lovely to be here.